I want to talk a little about the U.S. Good morning. Let's talk a little bit about what happened over at Wall Street overnight there. U.S. stocks slid from records as energy shares plummet with oil. Overall, let's talk about the oil there. When is this all going to bottom out?
I don't think the bottom is anywhere close. I had said last week we are due for another $10 of decline in the oil price. I think since then we have had about $4 or so of drop, Yvonne. So I think we have another $5 or $6 to go on the Brent and West Texas Intermediate. And that is going to be negative because the markets have assumed that lower oil prices are good for European and American consumers, and therefore it is a positive to the stock market. However, the negatives are that the high-yield bond market, 16% of the U.S. high-yield bonds are owned by energy companies, many of them in the fracking area, and they are going to have difficulty servicing, and you're going to find financial institutions and hedge funds which have difficulties as well because of the lower oil prices. So we are now seeing the underbelly of oil price decline, the negative parts of what we are going through.
Wow. And so we're talking about, crude being at this new 5-year low. Some say, I don't even want to touch oil stocks right now. Some analysts telling us there's a lot of noise and people aren't stepping in yet. Is that how you see things, too, in terms of the equities?
Yes, I do. I think the oil price going down further is clearly in the cards. If you compare with what happened in 2009, early 2009, Yvonne, oil price went to a low of $38 a barrel, compared with May of 2008, less than a year earlier, when it peaked at $145. So that time, it was all because of a fall-off in demand on the part of consuming countries due to the recession, the financial crisis. Today, you have not only a fall in demand, but also a huge increase in supply, especially the increase in fossil fuel in the United States over the last 18 months. So you have supply and demand both suggesting lower prices, and I think we have not seen the end of it.
Yeah, and we're coming off of just a pretty, celebratory report from the U.S. on Friday on that non-farm payrolls, 321,000 jobs added for the month of November there. Some signaling this could mean that the Fed might be lifting those interest rates a little earlier than expected, possibly, mid-2015 to the first quarter. You say, though, maybe not so fast?
I had said in 2013 that there would not be an increase in interest rates in 2014, which was out of consensus. And, of course, we have not had any rate hike this year. And I repeat that we will not have a rate hike in 2015 either because of several reasons. One, most importantly, we have the dollar already appreciating. It is stronger against most world currencies. Even China has a problem with the renminbi yuan depreciating recently. And at this time, if you have the Fed raising interest rates, let's say May or June of 2015, the dollar is going to be even stronger. You see then the euro going from the current 223 to 215 or 210. And you're going to have a lot of people in the United States saying that that is negative for exports, negative for employment. And S&P 500 companies, more than 50% of their revenues come from foreign sales. And that, too, is going to be negatively affected by the strong dollar. And today, in the U.S. edition of the Financial Times, the major story is the Bank for International Settlements warning about a strong dollar and the impact it will have on the globe, Yvonne. Under these circumstances, I can't see the Fed hiking interest rates.